Hello, today we are going to solve October 2022 paper question number 5 part D. Prepare the statement of financial position of the new partnership at 1st October 2021. So the parts of the financial statements are going to be non-current assets, current assets, and then you add up the total. Then you will have the capital account, current account, and then you add up these two. Then you also have to include current liability, non-current liability, and then you find the total of capital and liabilities. So it should match, the total assets have to match with the total capital and liabilities, okay, in the financial position. So let's calculate each of them. So first one is the asset, okay, non-current assets. So we will see what are the non-current assets he had. At the beginning he had 15,700. So we are talking about non-current assets, okay. Non-current assets, so we're at 17,500 plus, okay, he brought in a motor vehicle worth 5,000, okay, and uh, then a vehicle which was sold, so 8,000 cost, okay, it has to be removed. And then they also bought a new non-current asset which costed about 13,000. So all this has to be included. So let's add up 17,500 plus 5,000 minus 8,000 plus 13,000, okay, you have to add, and then you will get the value of 27,500. So let's write that, okay. So 27,500, okay. Then provision for depreciation. So let's see what is the provision. At the beginning it was 14,000, okay, and then we can see that he is saying that there was a removal, okay, removal of this or the selling of this non-current assets. The carrying value was 1,500. So cost minus the carrying value of that asset sold, it is going to give you the depreciation. It will be around 6,500. 8,000 minus carrying value is going to give you depreciation. So that is 6,500. So we have 14,000 minus 6,500. The value is going to be 7,500. This we have to reduce it. 7,500 is the total accumulated depreciation. Now because of that, okay, let's add up and find out what is the total non-current asset. So the value will be equal to, so 27,500 minus 7,500, that is equal to 20,000. Then we have the current assets, okay. Let's calculate the current asset value. So the current assets are going to be inventory, okay. First one we see that it is trade receivables, inventory, okay, we have to include. And also we have removed the goodwill, so we can't include that. And then bank we prepared, okay, the bank became, okay, the bank became positive, so it is going to turn into asset. So let's include. So first one is a inventory which was around 13,000, but there were some things, okay, which had happened to inventory, like um, 4,800 was sold, okay. First there was an inventory value, okay, we will see that inventory value which is 13,000, we have to adjust because certain things happened later on. So and 4,800 was sold, so minus 4,800. And then, okay, um, was there any other inventory thing that was done? He also brought in some inventory. Dennis brought in some inventory worth 3,000. So this has to be included. So when you add up all this, you will get 11,200. So let's add up the inventory. It is 11,200. So 13,000 plus 3,000 minus 4,800. Then trade receivables, okay, the trade receivables was at 11,500. So that is there is no change with the with that information. So 11,500. Then the bank, okay, the bank has become 10,300 after all this transactions. So let's write that it is 10,300. Okay, so now let's add up all this value. So we will get 11,200 plus 11,500 plus 10,300. So that value is going to be equal to, it is equal to 33,000. Okay, so 33,000. Now we have to add up total assets. Okay, 33,000, okay, is the non-current total of non-current assets. Now the total asset value will become equal to 20,000 plus 30,000, that value is 53,000. So 53,000, that's the total, um, that's the total assets, okay, in the business. Then we have the capital, okay. So for the capital of Ciara and Dennis, okay, we had been asked to prepare the balances. It is 11,000 and 14,000. So it is on the credit side, it is on the liability side. So you have to correctly indicate it as a capital side exactly. So you have to include 11,000 and then um, 11,000 for Ciara, and Dennis it was 14,000. Okay, 14,000 balances. And then, so this becomes 25,000. Okay, so the total is 25,000. So we can write the total capital, that is 25,000. And then for the current account of Ciara, okay, the current account of Ciara was 200 credit. So that also we can write 200. Okay, and we will not include Dennis because Dennis came in just now in October 1st, and we are also preparing the financial statement in the 1st October. In the 30th October, he will have the current balances and the other changes that is going to incur. So we will just prepare with the current account of Ciara. Next, we have the non-current liabilities. There was 10-year 5% bank loan. Okay, the bank loan was around 16,000. Okay, so they took a bank loan which was 16,000. So let's include that under the non-current liability section. So we had to add the capital and the current account. It is 25,200. Okay, so then the current non-current liability was at 16,000 because of the loan they had taken, and the current liability was a trade payable, okay, which included 16,300. Okay, 16,300. And was there anything else here? 16,300. And the trade payables, this was paid by check, so we have to reduce this trade payable. Okay, so initially we had, the business had to pay 16,300, but it had already paid 4,500. Okay, so the difference is going to be equal to 11,800 is the current trade payables. Okay, so it is 11,800. Now we have to calculate the total capital and liabilities together. So let's calculate that. So it is equal to 25,200 plus 16,000 plus 11,800. So when you add up, it will be equal to 53,000. So that is the capital, and so we can see that this has got balanced. Okay, so we just include that.